It's Thursday, March 18th. This is The Street Live. I'm Katherine Ross, and I am joined by Jim Cramer. Jim, let's talk about these markets. We've got the S&P and the NASDAQ down, but the Dow pushing higher. What are you watching?
Okay, I do recall, this is, again, the same period. I've been saying you got to be very careful. If you're Jay Powell, very careful if you're an investor in stocks. December 2015, Yellen decided to capitulate to the inflationistas and raise rates. And it was a disaster, and the economy just got crushed. And it was something that caused a tremendous decline even in the techs. Well, here we go. I mean, we've been in this path now. People have just been anticipating that that's going to happen. They're trying to sell the techs ahead, of what may be some disappointing forecast or disappointing number. And what I'm saying is, you know what, that probably will happen. But we're getting close to where the bottom occurred in that period where Yellen raised rates. And I'm not going to just say, you know what, you got to start selling all these techs here. People have been doing that. I've been saying that we've been in this, the level of stages of grief. We've been bargaining back and forth. I think today feels very much like you know what? I'm so depressed. Let's get rid of them, other than Kathy Wood. And so I'm looking for techs. And I'm thinking the banks have gotten ahead. And I think I want to make some sales. And that's a big change. It's going to be on our action alerts. I'm not going to give it away here. It's going to be an action alert video. But we're taking action right now. That is very typical of the against the grain kind of thing we like to do for Action Alert. A pure teaching moment, and I think we're going to be right.
Jim, one of the primary focuses that you and I have had, that Jeff Marks, who came on last week, and Kenny Polcari, who also came on last week, have all focused on is NASDAQ just sinking the way it has. So as we continue to see tech under pressure, this has got to be a worrying point for a lot of investors in tech. Do you have any homework that they should be doing to really cope with the NASDAQ?
No, I mean, I think this is a time to go back to these same issues. Sometimes you have to take pain. So the question is, how much pain do you want to take? We try to mitigate pain at Action Alerts by making most of our moves. I would say everyone, but we did make one errant drug move because we took a shot about, I usually don't take the shots, but took a shot about Alzheimer's. I still ultimately think we're going to be right. But we've been trying to mitigate all our tech moves by making every single buy in this period to be away from tech and make all the sells to be trimming of the great techs. And now we are in a position, when everyone is saying this, to do some buying. It is difficult because it's case by case. For instance, Google's was never up. Last year had been the laggard. Now it's a winner, and I wouldn't sell it. It's got great advertising dollars coming toward it. NVIDIA was already at 480. It's not going back to 480. But I am saying that you gotta just get tough, and the way to get tough and to steel yourself is to have a diversified portfolio where you have other areas like a DuPont, where we were heavily criticized. Then we kept our DuPont during that exchange with the IFF. Like a Goldman, which when was at 180, people felt, oh, you guys are crazy? And here it is at 356. I mean, we got to give it. That's nuts. 356, I mean, this stock is like double. So what I'm saying is that, and by the way, you can buy stocks like Union Pacific said some bad things. What did we do? We bought more. 3M yesterday said bad things. Now, we did not buy 3M. I wish we had. Ford has been saying bad things. Look at this Ford. They just did a $2 billion convert, and it's going right back up. So what we've done is choose to diversify away from tech, and then when tech finally got to the point where everybody is so depressed on tech, give me some tech. And that's where we are today.
In Jay We Trust was the name of your Real Money column from yesterday. And you note that investors who tend not to pay attention to the Fed or the bond market, which tend to be younger investors, and who tend to also buy the dip, make out like a bandit. Is this a case where perhaps putting blinders on would aid older investors who have always kind of followed the bond market and the Fed?
Well, there's two absurdities here right now. One is that you can get up at 3:30 in the morning and you see that the bonds looking like they're going to go down, interest rates going up, and immediately see selling of Apple and Microsoft. That's absurd to me, but that's some sort of algorithm. And then there's the absurdity of not even caring about the bond market, Jay Powell, just buying things. And the latter absurdity is winning. Now, the reason why the latter absurdity is winning is that there's this great middle ground of people who just say, listen, I'm putting money in the S&P. I'm putting money, my savings, every month. I'm just putting it in the index funds every month. So those guys are the trampoline, or some people could say the safety net. And the marginal buyer now is the younger buyer, the 17 million at Robinhood, the people, and I'm not going to say Reddit, Wall Street Bets, because Wall Street Bets is way too focused on just GME. But there are a lot of people who read Wall Street Bets who are not focused on GME. They're focused on the next opportunity. And what they're looking at is they're trying to find a Signet, or trying to find a CAT, or they're trying to find a Boeing. And those people who are trying to find, yes, the next Tesla, they are winning. The ones who just said, listen, I know what I'll do. I'll buy Kohl's. Stock's too low. I'll buy Macy's. Stock's too low. I'll buy Carnival Cruise. Stock's too low. I'll buy Southwest Air. Stock's too low. They won, and they continue to win. And I think that their lack of fear is astounding. But then again, the reason why ultimately I share their view is that they are young enough, Katherine, that if they were wrong about Carnival and Norwegian, if they had been wrong about Southwest, they would have all their lives to make their money back. So I think that they've been the winners, and I called it blissful ignorance. But the fact is, if you're big enough, you can move a stock and you can move a sector. And this together, we saw what they could do with GME when they were really concentrated buying. There's 9 million people on Wall Street Bets. We saw what they can do with GME, but what now we're also seeing is what they can do with the entire market. And when they get the stimulus checks, it's very interesting, because I think maybe the last time around, some of that went to the Dollar Generals of the world. Not this time. I think even more is going to go to the stock market. And I don't like anyone, by the way, who says that it's gamification on the part of Robinhood. Robinhood's an app. It's not a game. And if people think it is a game, they're going to lose money. But I just think that what matters is the Robinhood buyers equipped with the next stimulus check, who have jobs, are going to be in here buying, and we're not sure yet what they're going to buy. But if history says anything, they're going to buy the stuff that's most distressed, that they think is for real. And that could be tech by this point.
Yeah, I mean, I'm looking right now at Shopify, Jim, and it's kind of surprising to see over the past month that it's down nearly 18%, yet over the past year it's up 241%.
Okay, so let's talk about Shopify. I had them on last night, Harley Finkelstein, who is outspoken and fabulous. And, in another stage of my career, I would not talk about what they're doing for small business. I just talk about the numbers. That stage of my career gratefully is over. What Harley's about doing good and making a lot of money for shareholders. But Shopify, when I look at it, I say, well, how much is it down year to date? I want to buy a stock that's down huge year to date. It's not down. So
it's still up slightly, 0.31%.
It's too early. See, I'm looking for stocks that are down nicely for the year, and certainly from their high, in order to make a decision in this, thank you, Helene Meisler, world where I'm talking about the stages of grief. If you own Shopify, you are not grieving. You're still doing okay. And I think there are plenty of stocks where there's genuine grief, and that's where I'm trying to find. Let's use one that's closing in on it. ServiceNow. I love ServiceNow. I think it's great. It's down 15%. Not yet. In my parallel December 2015, which, by the way, I've used for months now. And suddenly people are realizing, wait a second, I think he's talking about a situation which could cause some sort of bottom, but we're not there yet. We're not there yet. But boy, you got to have cash for when you are. Because if you go back, and I'll tell you, the best one, you can go back, and this is a stock that we have long been linked with for action alerts, and for really my whole life, whole investment life, it feels like, but since 2008, is Salesforce. Okay, Salesforce is a big Dow stock. Salesforce is an amazing company. And if you go back and you look at this period that I've been talking about, the 2015-16, so Salesforce on November 30th was at 80, okay? And it looked like it was great. Then the Fed decides to raise rates. Stock starts going down. Then it turns out that the raising of rates causes a plummet in commodity prices and worries that the economy's weak. And LinkedIn says it can't make the numbers. Salesforce goes to 50. 80 to 50. Okay? That's the kind of move that I'm worried about that people should be ready for. And then what happens? Salesforce and Microsoft try to buy LinkedIn. The rest of the story is history. Salesforce goes from 50 to 150 without even blinking. So you want to be ready for the 50. It's actually $53 that it bottomed at. This is playing out again, 80 to 53. And when it gets to 53, you can't be the person who says, I can't take any more, so depressed. I accept, get the money back. No, I am preaching the opposite. And am I preaching? Yes, because I really, really, really don't want people to lose heart at the absolute bottom.
So, Jim, I really like what you say. I want to bring it back to Shopify for a moment, because let's say just by speculation, Shopify drops down to the point where you're comfortable buying. Do you think that it can keep up the pandemic momentum that we've seen with this focus on e-commerce and this focus on small businesses that you've spoken about?
Well, I mean, I still think, as I was saying to Harley, the business can be great, but the stock may not be great. I think the business, like I have, by the way, I'm interviewing tonight Jeffrey Silverman. I don't know if you know Jeff. Jeff is CEO of Etsy. And Etsy stock has peaked, but Etsy company is doing very, very well. It's just that people have decided, you know what, we don't want these stocks right now, and we don't think they can continue to be great. As a matter of fact, maybe they're going to be like Dollar General, where we thought it was going to do great, and it's not. And I would come back and say, wait a second, Dollar General's already down to 20%. I mean, that's kind of interesting. Shopify, were down more, I think would be a much easier call for me. I think their business is going to be huge this year. Remember, they're number 2 to Amazon, second largest e-commerce play in the world. I mean, well, I have to excuse it. I don't know. I'm sure the Chinese don't release these kinds of numbers, but the second largest in the Western world. And what I think is really amazing about what Shopify is doing is it's creating new businesses at an incredible clip. And that is going to continue. A lot of people felt that the businesses were being created were just being created because people were stuck at home. No, what's happened is that there's lots of business being created that can now rival larger businesses because Shopify makes it look like you have a large business. So I think Shopify is great, the company, but the stock, no, you can let it come down just because of what I just said, because of what I think can happen here.
Jim, another stock that you really liked was your mad dash this morning, Williams-Sonoma, and the company did post earnings.
Woo. Well, here's what happened. Why is the stock up 28? Was it really worth up 28? Well, there's two theories here. One is yes, because it was an amazing quarter and they had great day, 20 plus 25% comp, which is amazing. I think what was more important was that Laura Albert talked about the sustainability of the numbers. A lot of people felt that Williams-Sonoma was a pandemic play, and that once they lost the pandemic tailwind, they would have the headwind of the economy opening up. No, it turns out that while things were getting during the pandemic, she changed up a lot of what the company was doing. And what she's left with are things like the Williams-Sonoma store that are really doing incredibly well, that she's got an aesthetic that they didn't have before. She used the pandemic period to change up the merchandise. And the merchandise is getting big orders, even though the pandemic's winding down. So it's not really as levered to the pandemic as people thought, and that's why the stock is. So what you had is people shorting the stock. There was a big short position, betting this had to be the last good quarter, and instead she said, not the last good quarter. And the 8% short float is covering now furiously. They're afraid that they're going to be GameStop. They don't want to be GameStop. The short sellers know better than to be GameStop.
Jim, this stock is interesting. I mean, right now it's hitting its 52-week high, but it is up 328% in the past year. Obviously, with it being so high, I know that you're not going to say buy right here, but where would you consider saying that it's at an acceptable level to buy?
Well, look, it's a $12 billion company, and that's crazy. It should be much bigger than that. So I would say, even though the stock's up 29, let's say you wanted to buy 200 shares. I'd buy 50 here. I would. I buy 50 and I hope it comes in. Because it shouldn't be 12 billion. The kinds of numbers that Laura Albert is talking about makes it so that in terms of its ratio to its sales, 12 billion is way too small. it's going to be a very, very big retailer, and therefore it deserves a larger market cap. And that's the way I would use market cap analysis at this point.
Jim, Lordstown is facing an SEC inquiry for allegedly misleading investors. And your colleague on CNBC this morning, Phil LeBeau, did interview CEO Steve Burns, which we'll get to in just a moment. But I just want to get your first take on what to make of the Lordstown news.
Well, Nate Anderson Hindenburg first put out a report when I was away. They talked about how Lordstown has some serious issues with the truth. And I found it gut-wrenching because I had pressed Steve Burns when he was on the show, the CEO of Lordstown. I had pressed him on Mad Money about how serious the orders were for the company. And he said they're very serious. He had signed letters from CEOs. He could have easily said, look, we never know what's going to happen with orders, which is fine. You could have said that. He did not say that. Well, this morning, Phil LeBeau, who's an amazing reporter, asked him point blank. And Burns said, I never said that they were serious. I don't know where you got that. So then we ran the tape of when Burns said it to me on Mad Money. So to me, I felt it was like the prosecution rests. You don't even need to have a discussion. You just listen to what he said to Phil. And you listen to what he said to me. Case closed. You decide. I listened and I just said, that is someone that is hard for me to trust. And that's where I come out.
And for people who haven't watched this interview, either your Mad Money interview with Burns or Phil LeBeau's interview from this morning, first of all, you should. But second of all, the quote that really stood out for me from Burns himself was, I don't think anybody thought we had actual orders. To say that on television.
I know. I mean, he point blank said the opposite to me. And, you know, as I go through, I mean, it was, I mean, I had, obviously, I was frantically getting my people to cut the tape of when he was on Mad Money. But the quotes that we were struck by were basically, let me see if I can just call some of them up, but you know, we were struck by the fact that there was just simply no doubt in this man's mind that things were that the orders were serious and solid, and it was quite, you know, at one point he said to me, our average order size is 500 trucks at a time, and most of them are signed by the CEOs of these large firms. Now, is that not saying we have serious orders? So in other words, I'm asking the order serious. Make me feel better about how serious the orders are. Well, how about if you said, well, look, first of all, our average order size is 500 trucks at a time. And then I would also tell you that most of them are signed by the CEOs of these large firms. That's how serious I am. Well, that's the evidence. That's the core evidence. I mean, if we had to do like, stock market, CSI, well, there you go.
Stock market,
you know what?
CSI. I like that idea.
Stock market SVU.
Oh, we should launch that show, Jim.
Yes.
There is one other story that does have to concern the banks that I want to talk about before we move on over to our Action Alerts Plus Daily Rundown show. And that's just simply that it's reported that Morgan Stanley will be the first bank to offer wealthy clients access to Bitcoin funds. I mean, it really seems like Wall Street is really getting into crypto.
Yeah, look, I think you have to. I mean, I was kind of surprised. Like, everyone should offer it. Yeah, it's interesting because MasterCard would tell you, listen, we can do a trade in it. MasterCard is not a place that you think about as Bitcoin. But why should you? I was so glad that Morgan Stanley did this. Why should these older line companies continue to cede incredible business to two companies, to Square and to PayPal? It's almost as if they have said, you know what? We're going to lay down and play dead and let them do whatever they want to us. And their insistence on sniffing at Bitcoin, as Bitcoin goes ever higher, just makes them look more and more tone deaf, if not stupid. So I thought this was great. The younger people who got their stimulus checks last time, there is data which shows that that even more than buying stocks, they bought slivers of Bitcoin. And I think that that's business that went to Square and to Cash App that would have gone to E-Trade, Morgan Stanley. So I salute them. What they have to do, though, is get ahead of this. Like if I were James Gordon, whom I think is so fabulous and so much good stuff at Morgan Stanley, I would now ask my people, let's poll them. What do young people want? Go on Twitter. Tell us. I don't know. What do you want? Because Dan Schulman knows what they want. Jack Dorsey knows what they want. Stop giving up business to these upstarts. And speaking of that, I've got Upstart. It's a company I've been looking at that I know they did great. Encino's another one. There are some companies in tech, Affirm I like, but now there's a lot of companies doing buy now, pay later, including PayPal. But I just think, well, there's a reason why PayPal got its market cap and why Square has. And that's because they're listening. They know what young people want. And that's another reason why I salute Morgan Stanley. They're thinking younger than their competitors.
All right, let's end there. We're now heading over to our Action Alerts Plus Daily Rundown show. We will be talking about, as Jim and I have already teased, the banks. We're going to be hitting on Take Two, and we've also got some stuff to say about Nike. So join us over on ActionAlertsPlus.com. I'm Katherine Ross, and we'll see you tomorrow.